This is your macroeconomics video on problems with the money supply. The central bank of a country is trying to control the economy by using money supply and many tools to try to change it so that they can affect the interest rate. But of course, this is all done through the free market, and so a central bank cannot completely control all the time what the money supply is doing. One of the first problems is that people in households or consumers can suddenly decide to just keep more of their money in currency and have less in the bank if they choose to. So let's say that you just decide that you want to keep some money for an emergency in your house, and for some reason a lot of customers do this more than what the bank was planning. The bank now has less total money in its bank. That means the percentage that's required reserves is lower, and you can make fewer loans based on the other. And then, of course, the money supply falls because there's less money in banks. When the money supply goes down, that makes the interest rate rise. If banks decide that they suddenly want to hold more excess reserves than are required reserves, then that also means they can make fewer loans. So sometimes the banks get a little gun shy. So after a major recession, let's say where the bank lost a lot of money or had to get a bailout from the government, the next time the economy starts to get out of the recession, they might be a little more timid and might be really strict with who they're going to loan their money to, and thus they're only going to give money to people with the very best credit. That means they're making fewer loans, and that means they're making less profit on their loans. And so the whole system might not have enough liquidity in it. That could make money supply fall, and that would, of course, raise the interest rate. The Fed can also compensate for this type of household and banking behavior, but they typically have to do bigger measures in monetary policy than what they were predicting needed to be done based on the precise controls and measurements that they were doing prior to that. So there are various types of rates when you decide to go to a bank, and you can go onto the website for the bank that you bank at right now, and your bank will tell you what their various interest rates are on savings accounts, or if you want to borrow money to get a car loan or a home loan. We've talked about the discount rate. The discount rate is the rate at which banks borrow from the Federal Reserve. It is typically the federal funds rate plus 1%, so it's a little bit more expensive. Remember, the federal funds rate is the rate that banks borrow from other banks. Now, you need to keep these two rates separate, and the titles of them are the opposite of what you'd think they were. Federal funds rate is bank to bank. Discount rate is bank to Fed. The prime rate is your federal funds rate plus inflation plus an additional 2 to 3%. And then consumer loans for people who are going into banks to get general loans. If you are a very good customer who's got really good credit rating means you have a good income compared to how much debt you have, and you pay your bills on time every month, you're going to have the best credit scores. That means banks are going to give you really low interest rates, typically the federal funds rate plus 1%. Subprime borrowers are the borrowers with the worst credit scores. They either have a really large amount of debt compared to their income, or they routinely pay their bills late or skip payments altogether. You're going to have to pay a much bigger interest rate on loans, something like the federal funds rate plus 9%. The credit score of a person is not related to how wealthy you are. It's just related to how well you manage your money and how well you pay your bills every month. So it's possible for wealthy people to have bad credit scores and low-income people to have good credit scores. When you turn 18, you're going to start earning credit on your own name, and it's very important that you keep your credit score as good as possible. If you start paying bills late or racking up a lot of debt compared to your income, you are going to have to pay really high interest rates, and it will really harm your financial future when you become an adult and you want to buy a house, or you want to send your kids to college and get student loans and things like that. You really need to make sure that you're saving money and you're paying your bills properly. All of these interest rates are stemming from the federal funds rate, which we already talked about is targeted by the Federal Reserve Bank using open market operations. And then all of the rates in the country are added 1, 2, 3, 9% on top of the federal funds rate. So when we say that the interest rate goes up or down, all of these are going up or down by the same amount.